Okay, I'm going to start with a viewer question, your stock our take segment on Athabasca Oil Company, symbol is ATH on the TSX, $6.31, $3.15 billion market cap. Doesn't pay a dividend, but they are returning capital to investors via share buybacks. They are a Canadian energy company focused on the exploration, development, and production of thermal oil and light oil assets in the Western Canadian Sedimentary Basin, that Alberta, Canada, essentially. Founded in 2006 as a private company, they followed an aggressive land acquisition and joint venture strategy during the oil sands boom days that tracked an increase in global oil prices. Athabasca then completed its IPO in April of 2010, issued 75 million shares, $18 for gross proceeds of $1.4 billion. So you can see the share price is significantly lower, about a third of where it actually IPO'd. The business is typically organized into two main operating segments. Thermal oil, this segment focuses on exploration, development, and production of bitumen from oil sands, primarily using in situ methods like steam-assisted gravity drainage, or SAGD, in the Athabasca region of northern Alberta. This segment is the primary source of revenue. There's light oil through a 70% stake in its private pure play Duvernay subsidiary, Duvernay Energy Corp. This segment involves the production of light and medium crude oil and liquids-rich natural gas from unconventional reserves, particularly in areas like Greater Kaybob area, including the Duvernay Shale play. Athabasca Oil provides 100% payout of its thermal oil free cash flow to shareholders by distributing it to all share. It's essentially driven into share buybacks, a strategy outlined in its 2025 budget and financial reports. By using buybacks instead of dividends, the company aims to increase cash flow per share for its investors. So let's see how is the share price done over the past year. Done fairly well in a weaker oil environment, up 23, just under 24%. But this is all time since it IPO'd. Not the greatest performance, down 60% there since the company IPO'd. Right now, let's look at some business highlights. Here is a corporate snapshot. Producing approximately 40,000 BOE, barrels of oil per day, which is about 98% liquids. And the company boasts long life assets with low base decline. Core cash producing assets is used in share buybacks. Those are the thermal oil assets. These are predictable, low decline projects, efficient brownfield SAGD development in place as well, and it has a strong reserve life. The plan is, again, like I said, to deliver 100% of the free cash flow and return that to shareholders. They estimate that there's about $1.8 billion of free cash flow to be had between 2025 and 2029. That would be at about $70 WTI. Has already completed $650 million in cumulative share buybacks since April 2023. There is a good tax-free horizon here, $2.2 billion of tax pools. Growth will come from a number of areas, but there is the Leismer 40,000 barrel a day progressive expansion over time that's projected to cost around $300 million. The approvals, the regulatory approvals to do 40,000 barrels a day have been received here. There's further upside through their joint venture. This is a private company, the Duvernay Energy Corp. It's a pure play subsidiary, self-funded and flexible development, de-risked resource and high margins here. Again, it is a private company. It is Athabasca operated, 70% owned, and Cenovus owns the 30%. They have an equity ownership at 30% in that as well. Right now, production is around 4,000 barrels of BOE per day. And the exit rate for this year is predicted to be between 5,500 and 6,000 BOE per day. It's self-funded. The growth potential here is to get up to around 20,000 BOE per day, about 75% liquids. That would be by late in this decade. So significant growth potential if that is achieved. Let's look at the recent results. The highlights here: average production about 39,000 BOE. 98% liquids. That is 4% growth, which is solid, 15% per share growth, largely because of the share buybacks. This is something, in terms of production, it's something management can control in an energy company. So it's good to see some growth there. Cash flow, adjusted funds flow, 25 cents per share. As we can see here on a per share basis, it's actually down 17% to 20 cents from 24, driven by lower energy prices. That's something the management really can't control. Let's look at those share buybacks. Purchased 24 million shares through its buyback program year to date. Athabasca is committed to returning, again, 100% of its free cash flow from its thermal oil, and has done significant buybacks since 2023 already, reducing its fully diluted share count by 21%. Strong financial position. There is net cash of 119 million. Let us look at the company's outlook. Their production outlook, they anticipate production at the upper end this year of guidance of 37,500 to 39,500 barrels of oil per day, with an exit rate of 41,000 BOE per day. Thermal oil production is trending at the upper end of prior guidance. The Duvernay energy is expected to average around 4,000 BOE per day, with an exit target of 6,000 BOE per day, following the tie-in of 2 multi-well pads. The focus here is on free cash flow, to generate that through the thermal oil assets, as we can say, and to buy back shares. And there is some growth also in that side of the business, and then to grow with the Duvernay assets. Let's look at the valuations. Based on 2025 expected numbers, Athabasca's debt-adjusted cash flow multiple is around 5.4. Their peers are around 6.3. So it's a discount, but not a severe discount to peers. Some of the boxes that we look at in a conclusion here, generally to check off with an energy company, it will see if Athabasca checks those off. Does it have a strong balance sheet? It is net cash, so we check that off. Production growth here over the long term, we check that. Relatively long reserve life, yes, that checks off. Low cost production, it's a check here. Low to reasonable valuations. Well, given the weakness in energy in the near term, we'd say it's just kind of trading near fair value. Good management team, that would be under review still. Overall, Athabasca combines long life, low decline thermal oil assets with high growth potential from its light oil reserves, or moderate to high growth, I would say. Intriguing in the near term, but faces weaker near-term environment. Intriguing in the long term, I would say, but it faces that near-term weaker environment. So it's a company we certainly monitor, and we do like the balance sheet and those share buybacks. All right, guys, did you have any comments on that?
Yeah, I just think the only thing that I would say is I like your conclusion where, you're showing, where it's checking off the boxes. Because even as you were going through the segment itself, I was thinking, I'm checking off the boxes in my head. Net cash, production growth. These are the things that obviously we're looking for. But yeah, it doesn't look bad.
Yeah, it's certainly interesting. I mean, we have some a name or two that trade at lower valuations, have great balance sheets as well, but not necessarily the long reserve life that Athabasca has. So, I mean, there is there's definitely some interesting, we would have some interest in this company. We continue to look at it. So for the viewer that sent that in, yeah, it's a company that piques our interest, and we have been looking at, and we'll continue to look at. If it pulled back in a weaker oil environment, given the long-term life of the assets, it may be a company that we'd look at.
Yeah, especially on just like you were saying, the lower price, that's going to start to, we're in the range where you're going to start to see companies that are hitting their break-even points in the US and Canadian fields. So do we start to see actual production decline if we do see a persistent, especially sub $50 WTI? Do we start to see production actually substantially decline? Because for Athabasca, they're noting a $55 WTI for their capital break-even. So that right now they're effectively at break-even for capital for the growth profile and the shareholder returns, which is good to see. It's not some players that are significantly higher, especially if they have debt on their balance sheet. It can really hurt very quick if you start to see these below 50, especially if you hit the 40s. they can get hit hard very quick, and they can actually just go right out of business if they aren't in a debt position, which Athabasca is in, which is, like Brendan was saying, checks a lot of boxes.
Yeah, and that's why we stress very strong balance sheets in these businesses, commodity-related businesses generally. Even if you have great long life assets, if in the short term the price turns against you and you're producing negative cash flow, you have debt. We've seen companies with good assets have to continually dilute to just get back to the times when they can make money, and not just, it's not something you want to see as a shareholder, and it doesn't achieve long-term returns. Again, we got to look back further on Athabasca. There has been negative returns since this company has IPO'd. It was a different time then. There was a ton of optimism on the oil sands, and now we're looking at these assets differently. But there is free cash flow coming, and if we're not converting completely to electricity in the next 5 minutes, there's probably some value in this business over the mid to longer term.
Question for you before we move on. Just looking at this space, and how we've seen investors chase yield a lot of the time. Do you like the strategy of the share buybacks being more nimble than potentially having a dividend? I mean,
Yeah, I mean, I think it's not. I think that we always say that a dividend in an energy or a commodity related business is a bonus, even if there's a low payout ratio. It's such a fluctuative market, variable market. In this case, they don't have to keep funding that dividend. They could just buy back less shares. So potentially, people know that they're trying to grow free cash flow over time. It may be a better way to structure that business. I think some of those companies get in trouble. They have to cut their dividend. They bring it back, cut. It would be less noticeable to the average investor. I think the average investor should always look at these companies and as a dividend, as a bonus. They don't. They buy it for the yield, then they may sell it off if there's a cut. In this case, it may be a more effective way of holding, of communicating to investors. You don't have to keep that dividend, and it communicates poorly to investors when that dividend is cut or reduced over time. So in this case, I mean, the goal in any business is to increase your per share cash flow over time. This can help with that. So it may be a more effective way, smarter way of positioning themselves. So dividends and share buybacks, they're all shareholder friendly. In these cases, like, they're going to be very variable in this business. Like, the cash flow this year versus last year has shrunk. So the buybacks this year versus last year have shrunk. If you have a dividend that fluctuates like that, the market doesn't typically reward you for that. So, I think maybe they're saying the market doesn't care if we have a dividend. Let's just buy back shares effectively over time and then increase per share cash flow. So yeah, it could work. We will see in 10 years. But it's interesting for sure.